Am I the only one that didn't know how confusing the stock market can be? Those fluctuating numbers, cryptic symbols, and financial jargon can seem like a language only spoken on Wall Street. But guess what? You don't need a fancy finance degree to understand the basics of investing. This essay is your crash course, your cheat sheet, your backstage pass to the world of stocks. We'll break down complex concepts into bite-sized pieces, using simple language and relatable examples. By the end, you'll be surprised how much you've learned. So, whether you're a complete novice or just looking for a refresher, grab your metaphorical hard hat. We're about to demystify the stock market together. Imagine your favorite company is baking a giant apple pie. This pie represents the company's total value, its assets, and its potential for growth. Just like a pie, the company is made up of various ingredients: its products, services, employees, and innovations. Wouldn't it be amazing to own a slice of that pie, benefiting from its deliciousness? When you own a slice, you get to enjoy the fruits of the company's labor. You share in its successes, and sometimes its challenges. Well, that's precisely what the stock market allows you to do. Own a piece of companies you believe in. By purchasing shares, you are essentially buying a portion of the company, giving you a stake in its future. The stock market is essentially a giant marketplace where you can buy and sell these slices, known as shares. It's a dynamic environment where prices fluctuate based on supply and demand, company performance, and broader economic factors. When you buy a share of a company, you become a part owner, also known as a shareholder. This means you have a vested interest in the company's success, and may even have voting rights on certain corporate decisions. This ownership comes with potential rewards, like increased value of your shares and a share of the company's profits, called dividends. Dividends are periodic payments made to shareholders from the company's earnings, providing a source of income in addition to any increase in share value. Of course, just like any marketplace, there are risks involved. The stock market can be volatile, with prices rising and falling based on a variety of factors, including market sentiment, economic indicators, and geopolitical events. The value of your shares can go down, and companies may not always make profits. It's important to be aware that investing in the stock market carries the risk of losing money, especially if the company underperforms or the market experiences a downturn. However, understanding the basics can help you make informed decisions and potentially grow your wealth over time. By researching companies, diversifying your investments, and staying informed about market trends, you can navigate the stock market more effectively and work towards achieving your financial goals. Investing in the stock market can be a rewarding experience, offering the opportunity to build wealth and secure your financial future. With patience, knowledge, and a strategic approach, you can own a piece of the pie and enjoy the benefits that come with it. Before we dive deeper, let's familiarize ourselves with some key terms that are essential to understanding the stock market. These terms will help you navigate the complex world of Wall Street with more confidence and clarity. Stocks. Those slices of pie we talked about, representing ownership in a company. When you buy a stock, you're essentially buying a small piece of that company, making you a part owner. This ownership entitles you to a share of the company's profits and assets. Dividends. A portion of a company's profits distributed among its shareholders. Companies often pay dividends as a way to reward their investors for their trust and investment. These payments can be made in cash or additional shares of stock. Imagine getting a little extra pie just for owning a slice. Dividends can be a great way to earn passive income from your investments, providing you with regular returns without having to sell your shares. Portfolio, your collection of investments, like a basket holding all your different pie slices. A well-diversified portfolio can help manage risk by spreading your investments across different assets, industries, and geographic regions. Bull market. A period of rising stock prices, like when everyone wants a piece of the pie and is willing to pay more for it. Bull markets are often driven by investor optimism, strong economic indicators, and positive corporate earnings. Bear market. A period of declining stock prices, like when the pie isn't so appealing anymore and people are hesitant to buy. Bear markets can be triggered by economic downturns, negative news, or widespread investor pessimism. Don't worry about memorizing these terms right away. The more you explore the stock market, the more familiar they'll become. As you continue to learn and engage with the market, these concepts will start to make more sense, and you'll feel more comfortable using them in your investment decisions. Remember, every expert was once a beginner, and with time and practice, you'll be speaking the language of Wall Street fluently. Section 4. The Dance of Supply and Demand. Now, let's talk about how prices are determined in this exciting marketplace. Just like that delicious apple pie, the price of a stock fluctuates based on supply and demand. When more people want to buy a stock, demand, than sell it, supply, the price goes up. Imagine everyone lining up for a slice of that limited edition pie. Conversely, when more people want to sell than buy, the price goes down. Maybe the pie is past its prime. Various factors can influence supply and demand, such as company performance, economic conditions, and even investor sentiment. Understanding these dynamics is crucial for making informed investment decisions. Section 5. Common stocks versus preferred stocks. Picking your team. Not all stocks are created equal. In the stock market game, there are two main teams: common stocks and preferred stocks. Common stocks are like the star players. They offer voting rights in company decisions and potential for higher returns. However, they also come with higher risks. Preferred stocks, on the other hand, are like the reliable bench players. They offer priority in receiving dividends and tend to be less volatile, but they usually don't come with voting rights. Choosing between common and preferred stocks depends on your investment goals, risk tolerance, and individual circumstances. It's like picking your team based on your preferred playing style. Section 6. Dipping your toes in the market. Tips for newbies. Ready to take the plunge? Investing can seem daunting at first, but with the right approach, you can make informed decisions and grow your wealth over time. Here are a few tips for beginners. Do your research. Before you invest a single dollar, take the time to understand the basics of the stock market. Read books, follow financial news, and consider taking an online course. Knowledge is power, and the more you know, the better your investment decisions will be. Don't just buy a stock because everyone else is. It's easy to get caught up in the hype, but following the crowd can lead to poor investment choices. Instead, focus on making decisions based on your own research and analysis. Understand the company, its financials, and its future prospects. Look at the company's earnings reports, balance sheets, and cash flow statements. Consider the industry it operates in and its competitive position. A well-informed investor is a successful investor. Start small. You don't need a fortune to start investing. Begin with an amount you're comfortable with, even if it's just a few dollars. This way, you can learn the ropes without risking a significant portion of your savings. Begin with a small amount you're comfortable with and gradually increase your investment as you gain experience. As you become more confident and knowledgeable, you can start to invest larger amounts. This gradual approach helps you build your portfolio steadily and reduces the risk of significant losses. Be patient. Rome wasn't built in a day, and neither are successful investment portfolios. The stock market can be volatile, and prices can fluctuate in the short term. However, over the long term, the market has historically trended upwards. Patience is key to weathering the ups and downs. Stay focused on your long-term goals and don't panic over short-term market fluctuations. It's easy to get emotional when you see your investments lose value. But remember that investing is a long-term game. Stick to your plan and avoid making impulsive decisions based on short-term market movements. Remember, investing is a marathon, not a sprint. Building wealth through investing takes time and discipline. Stay committed to your strategy and don't be discouraged by temporary setbacks. Over time, your patience and persistence will pay off. By staying informed, starting slow, and remaining patient, you can navigate the stock market with confidence. Keep learning, stay disciplined, and remember that every successful investor started as a beginner. With these tips, you're well on your way to becoming a savvy investor. Section 7. Embark on your stock market adventure. Congratulations, you've just completed your crash course on the stock market. While we've only scratched the surface, you now have a basic understanding of what the stock market is, how it works, and some essential terms. Remember, investing in the stock market can be a rewarding journey. But it's crucial to start with knowledge and a healthy dose of caution. Don't be afraid to seek advice from financial professionals. Continue learning, and most importantly, enjoy the ride. Now that you're armed with this newfound knowledge, go out there and conquer the world of investing.